So let's turn back to the major indexes. Joining me now is Jeff Small, president of Arbor Financial, a firm that's become a retirement income store. Thanks so much for joining. Bit of a breather in the markets today after several strong weeks and really several strong days of gains. What was behind the market action?
Well, I think the market got a little oversold and it got very emotional because the fundamentals of the economy are extremely strong. But that combined with the Ukrainian issues and some of the geopolitical deglobalization potentials and rising rates really stoked the emotional side of the market, even though there was really no reason for the market to really fall like that, other than it was time for a pullback. We haven't had one in quite some time, Christine.
So how's your outlook, Jeff, changed at all? Investors buying the dip, you mentioned we basically were in oversold conditions, but there are still unresolved headwinds out there, right? Russia's still in Ukraine, showing no signs of backing down. Inflation is still here. Higher rates are on the horizon. How does this change your view for the full year?
Well, I remember last year when everybody was stoking the fears of inflation and there was a big argument on the major media outlets about how this was going to be a transitory issue. Well, boy, were they wrong about that. It's definitely not transitory. However, it's the economy, dummy. Forgive my bluntness, but that's what causes the market to grow and contract. And so right now, the economy is doing well. We have 95% of all S&P reporting companies with a 6% earnings above expectations, up by 6% as an average. And so as long as we have forward momentum, we look good. But to answer your question further, Christine, we know we've got some rate hikes coming. And yes, we do have PE compression when interest rates go up. We know that. But it doesn't mean the market can't grow. Out of the last 11 rate hike cycles, only 3 times did it cause an actual bear correction on the first cycle, the first rate hike. The average increase for the other 8 or 9 rate hikes was around 17% from about the time of the first rate hike. So yes, we don't like to look at history, but it will repeat itself in this sense because the economy is just too strong right now.
So we have another earnings season approaching. Mid-April, we'll start to get earnings from the banks. Of course, all of this for the first quarter as Omicron cases were rising and I think impacted many companies' return to work plans. What are you expecting this first quarter earnings season, and what should investors be prepared for when it comes to stock moves?
I think that from an earnings perspective, you've got to be very careful for the average investor. We got some disappointments last quarter. We had a disappointment from Netflix, from Facebook, actually even from Home Depot, believe it or not. And so I would look for earnings to start to contract because just take a look at consumer sentiment. It's starting to change. People are starting to pull back because of the inflationary pressures on energy costs, food costs, and the cost of living. But our outlook is still positive. So where do you go today? Well, you look at companies that don't have extended and overreach multiples that have high dividends and what we call, to use a Buffettism, value stocks. Value stocks are where you go in this type of economic environment.
And what would some of those value stocks be, Jeff?
Well, there's value stocks in every category. I just happen to have my trusty list right here. And so I'll give you a few of our picks. And the consumer staples, we like Unilever and Walgreens. They've got great dividends at 4% and 4.2%. And in the energy sector, as examples, we have Valero and Enbridge with great dividends at 4.1 and 5.9%. I've got 30 picks, but I don't think you have time for me to go all over those. But what we're looking for is something that pays a good dividend in this type of environment, and that's where investors need to focus.
Well, and I know your customer base is our retirees, helping retirees with their financial decisions. So certainly income plays would make sense here. Would you say mostly with income plays for the retirement age group?
Well, you know, it varies. Most retirees need an augmentation to their income from their portfolio besides Social Security, besides pensions if they're lucky to have that. And their portfolio will generally contribute 30 to 45% of their total income. So yes, generating interest earnings through dividends or yields is the key to a fun and happy retirement if you want to have more income than you need.
Interesting. Now, what about oil prices? How does that alter some of your clients' portfolios? Of course, I've had people tell me that they've simply had to delay retirement due to rising gas prices.
Well, we haven't seen that kind of an impact yet, Christine, but obviously what it impacts people on fixed incomes, because when you retire, you have less income and hopefully no debt. But when things cost more and they go up in value, like energy and oil and expenses and gas and food, that impacts your bottom line. And so it's really important for investors today that are retired to make sure they're getting that interest earnings to cover that additional expense as inflation goes up, because we are going to face some more inflationary headwinds here.
Talk to me about the economic signals, Jeff, that you're seeing that is indicating that this economy is strong.
Well, it's very basic. We're at full employment. We have a 3.8% unemployment rate, which we're basically below the pre-COVID levels of March of 2020. The bad part of the economy is that quantitative easing has ended. There's no more stimulus. And when we have less stimulus, we have less goods being purchased, which means there's going to be a contraction. And so you look at kind of the big pictures of things to see what's happening, but stay away from things that are overpriced. And there's still quite a bit of the growth stocks, especially in the NASDAQ, which has been severely beaten up, are still significantly overpriced.
Are there any sectors outright, Jeff, that you're just avoiding, that you don't want to touch here?
Well, at this point, since the market has capitulated and volatility has left the building, we are staying away from growth plays at this time because we see more volatility in the short term on growth plays.
All right, we're going to leave it there. Jeff Small, thank you so much for coming on the show. He's the president of Arbor Financial.